And that chart really shows the three imbalances that we have that really reinforce my views about where to invest in the next decade or so. And that's really related to the debt problem that we have, that we're very similar to levels that we saw back in the 1940s. And then we have a valuation problem that we saw back in late 90s and also the late 20s, right before the Great Depression. And the third one, which is related to the inflation problem, that is very similar to what we saw back in the 70s. So we've seen those imbalances in the past, but we have never seen this trifecta of macro imbalances all at once. And when you think about those issues, and you compare with the 70s, well, you have an inflationary problem with prices rising like we saw back then, but there was no debt problem. There was no valuation problem like we have today. So what does it all mean? To me, it means that political, I would say policymakers are extremely constrained from their end to prevent inflation from growing in the system over time. At a time when you have the allocation for most assets or most portfolio managers and large institutions focus mostly in equities, especially technology, still mega cap companies and so forth. Used to be software that's been shifting away from that, and still, broadly speaking, I would say the allocations remain very large in equity markets in general, relative to other things like commodities, like gold itself. And I do think that over time, this issue of not being able to prevent inflation from growing in the system will eventually translate into higher prices for tangible assets. When do you own tangible assets? When you have those constraints, when you have an inflationary regime. And a lot of people will think that inflation is going to go away because we're going to go through waves. But those waves are usually progressively larger as they develop themselves. And I think that we're at the beginning of an inflationary era, which is going to change consumer behavior. And it's also going to change how portfolios will look like in terms of allocation 10 years from now. And I think if I would pick my own crystal ball, would probably be a lot more tangible assets relative to equity markets. And so I'm concerned about the equity portion in terms of the overall stock market, as I am also very attracted by ideas in the tangible assets realm.
Yeah, it's like I fully agree with you, right? It's tough to disagree, and it's like in the question sort of is like trying to disprove your own theory, right? Like everything points in that direction. I have to agree. Like all the ratios and everything you look at sort of points in the tangible asset scenario. Anything that sort of lets you at least question a little bit your theories, anything that you look at is like, oh, if that changes, I might have to sort of rethink what I'm doing?
Absolutely. I think, well, the trifecta of macro imbalances, I have to think about each of them, and would that be any way that they could resolve themselves somehow without unleashing some of those macro trends. And we've seen in the past one example, which was during Industrial Revolution and some other times that I'm referring to, big changes in productivity. And if we do see some sort of technological advancement that makes a large shift towards that allows us to go back to a world where we're able to produce more units of growth relative to units of debt, where we see a deleveraging process driven by productivity, then I'm wrong. And I pay very close attention to that. Some folks used to say that was probably artificial intelligence. Some other folks would argue it was probably crypto. I don't think it's that. I don't think we're going to see on the back of those shifts a real change in productivity like people are pricing in markets still. And I think artificial intelligence may be one of them at some point, but I think we're too early to call it that being what may cause economies to be able to grow relative to how much leverage they have. And if I start seeing leverage decline because of those shifts, then I need to be paying very close attention, because my thesis is unlikely to play out. Other things would be, I think on the commodity side, I think about the inflation side very closely. Look, I think inflation is usually very secular. I call it the pillars of inflation. So if you think about it, we have number one, the wages and salaries growth. And wages and salaries growth is something that has started recently. We've been through 30 years basically of declining growth in wages. It's hard to believe that this ramp up that we saw recently is not going to be a big shift going forward. I think that we're going to see something along those lines. But, if that shifts, I think that would be an important concept to be considering. I would say that especially fiscal spending has been reckless relative to any other period in history. If that changes, I would certainly, question a little bit my thesis. I would say the deglobalization trends, if they go away from that. So if we start seeing again developed economies benefiting from cheap labor, that's probably going to be a challenge for my thesis. I'm not seeing that either. I'm seeing the opposite of that. And let's just say, if we see a major discovery of different natural resources that allows us to have enough resources to go through what I think it's going to be a problematic period of those being quite scarce. And so, if those are, I believe we're going to go through an exploration age. But first, we got to find those resources, and we got to finance those companies to find them. And that's why I'm invested in exploration. But I don't think it's going to be that easy. I think it's going to be difficult. I think you're going to have to bet on high quality teams. There's a lack of geologists in the space. There's a lack of knowledge of how to navigate the space. So, of course I pay attention to that, but I'm not necessarily seeing that we have abundance of natural resources in the medium and short term that will translate into lower prices of tangible assets because of an excess of supply. But again, those are the things that are in my mind when you ask that question.
I know, fantastic. Tavi, a phenomenal conversation. Maybe one last one. Let's see if we can answer it quickly. Where's gold going to exit the year? You have
a price point? Is that what you're saying?
Yeah, price point. Yeah, gold price. I don't know, just to wrap up the conversation.
I do think, gold will continue to go higher from here. But again, Kai, I've said this before. I think the biggest, most important thing for investors is to have obviously a long-term plan. When I ran my numbers and I realized that I have a thesis on precious metals for the next 10 years, the first thing I thought was, how do I make money out of this? And I realized very quickly that wasn't through just buying gold, because I think it's going to be difficult to find those excessive types of returns into just buying gold. And so the immediate reaction is, how do silver looks like? And silver just looked more asymmetric than gold. And then you go back and see the ratio at about 80 historically today is not normal. It's usually times you want to be allocating capital in silver. And then you go to the next one, which is miners. And you're like, wow, those things look cheap. And then inside of the mining cycle of any business in the space, you find the exploration, development, and production parts of the industry. And each person will find their own niche on analyzing those companies. We found our niche in mostly exploration and development. And that's really where I think you can find even better payouts. But that's just my opinion. So I think gold will go higher by the end of the year, and probably higher for the next year or so, especially after seeing the sentiment getting so damaged recently.